Welcome. We're going to break down what's happening right now in the world of annuities, because frankly, it's a historically good opportunity. All the insights today come straight from our team at the Annuity Expert.
Okay, so let's jump right in. If you're thinking about an annuity, it's easy to just look at today's rates. But here's the secret. To really know if you're getting a great deal, you have to see how today's numbers compare to the past. It's all about context. And believe me, the context right now is fantastic for buyers.
First up, let's talk about the simplest way to get guaranteed growth on your money. We're talking about the multi-year guaranteed annuity, or what everyone just calls a MYGA.
So what is a MYGA? Well, think of it like a certificate of deposit, or a CD, that you get from an insurance company. You give them a premium, they invest it safely in bonds, and in return, you get a locked-in, guaranteed interest rate for a few years. And here's the best part. Your interest grows tax-deferred.
And this is where that historical context really hits home. Just look at the difference. For a solid decade, MYGA rates were kind of snoozing in that 2 to 3% range. But today, wow, we've seen a huge surge, with rates now sitting between 5 and even hitting 7%. That's a massive shift that makes these things way more powerful.
So who is this for? It's really perfect if you're looking for safety and predictability for your retirement money. Maybe you've got an old 401k you need to roll over. You want a better return than a CD but without any market risk. As long as you can leave the money there for the term, a MYGA is designed for you.
Okay, so let's switch gears. What if your main goal isn't just growing your money, but actually creating a guaranteed paycheck for yourself that starts right away? Well, that's where the SPIA comes into play. The idea here is really simple. You make one single payment, a single premium, and in return, the insurance company starts sending you a check, often for the rest of your life. Now, the size of that check depends on your age and, this is the key part, the interest rates the day you buy it.
And this is where today's rates make a huge difference. For years, when interest rates were basically zero, a 65-year-old might only get a 4 or 5% annual payout. But today, with higher bond yields, those lifetime payouts have jumped like crazy, often over 7%. That's a massive raise in your retirement income, locked in for life.
You know, SPIA is really built for the person who says, I just want to turn this chunk of savings into my own personal pension. It's for somebody who values that steady, reliable paycheck more than anything else, and is okay with giving up access to their initial investment to get that lifelong guarantee.
Now for our third option. What if you're a little more cautious? You like the idea of stock market growth, but you absolutely, positively cannot risk losing your principal. This is the exact problem that fixed indexed annuities were designed to solve.
So here's how it works. Your money isn't actually in the stock market. Instead, your interest is just linked to a market index, like the S&P 500. If the index has a good year, you get a piece of the gain. But if the index goes down, you just get a zero. Your principal and all the interest you've already earned is always protected. And just like the other annuities we've talked about, this higher interest rate environment has made these products so much better. Insurance companies can now offer higher caps or participation rates. That's just fancy talk for how much of the index's gain you get to keep. And that means your potential upside today is way higher than it has been for a decade.
So the bottom line here is that FIAs are a fantastic middle ground. They're for people who want to dip their toe in the market for some growth, but who are absolutely not willing to risk losing their hard-earned savings. It's a protection-first strategy with a pretty nice potential for growth.
Okay, before we move on, I really want this to sink in. Whether you're looking for guaranteed rates, income for life, or protected growth, the deals on the table today are the best we've seen in more than 10 years. And if interest rates start to fall again, this unique window of opportunity, well, it's going to close.
This is a question we hear all the time. So what happens when my guarantee period is over? It's a great question, because understanding your options at the end of the term is just as important as picking the right product in the first place.
For MYGA, when your term ends, you get a 30-day window to decide. You can just renew with the same company, but you'll get whatever their new rate is at that time. A smarter move is often to shop the market and transfer your money, tax-free, to a new company with a better rate. Or, of course, you can just take your money and go. Now, for an FIA, things are a bit different. The contract doesn't actually end, it just gets a whole lot more flexible. Those surrender penalties for withdrawing money disappear, so you have full access. The contract keeps earning interest, but your caps and rates will now adjust each year to whatever the current market looks like, so you'll want to review it annually.
So we've gone over the different kinds of annuities, we've talked about why today's market is such a historic opportunity, and what happens down the road. So what's the next logical step for you?
It all really boils down to this, doesn't it? Which of these tools, if any, is the absolute right one for your unique financial plan? And how do you sift through all the different companies to find the best rates and features out there today?
Well, that's exactly where we can help. At the Annuity Expert, our whole job is to help you compare the top options from the best A-rated carriers to find the perfect solution for your goals. And our guidance and comparison services are always completely free to you. So please don't hesitate to give us a call or visit our website for a personal consultation. Thanks so much for watching.